stop sharing myself and hand it over to you. Thanks again for being here.
Yeah, no problem. Michael, before I get going, can you give me a sense of who is in the audience in terms of where they work within just give me some sense of that if you don't mind.
Yeah, sure. We have let's see, a pretty diverse crew. Let me look at the registrations. I know I recognized one or two Department of Revenue people. But broadly, the organization is, let's see, management, there we go. Broadly, the organization is for data analysts, both people kind of more on the technical side, like, SQL is a common topic during our different trainings for different languages is something that we're looking at doing. But yeah, we have people from all different agencies within the Oregon state government. Let's see. Can I see registrations? There we go.
Okay.
Yeah, so we've got some people from employment, Department of Human Services, Oregon Health Agency, our administrative agency. Yeah, we've got people from a variety of, and some of them are waiting to be let in.
That gives me sense. Thanks, Dave.
Yeah, mostly I would say more technical than not is the general.
Okay.
Yeah.
Are there folks from the tax agency or from the social services agency who are likely to be on?
Yeah. We've got, I think, including myself, I think I counted 4 Department of Revenue people, and then we've got people from our Department of Human Services, a few, I think 3 or 4 or 5.
Great, excellent. Well, thanks for having me today. My name's Evan White. I work as the executive director of a place called the California Policy Lab, which is a research institute based at the University of California. And I'm going to talk a little bit today about the work that we've done in California that works across different agencies within the state to try and get more people onto benefits that they're eligible for. And the way we do that is by linking data using a somewhat innovative method that Michael invited me to talk more about here today. So the sort of challenge that we, well, actually, are you able to see my slides?
Yeah.
And anyone,
and by the way, yeah, everyone kind of feel free to use the chat if you, hopefully it's not disabled or anything. Any of the DOR people ping me on Teams if it's disabled or something. But if you have questions, yeah, feel free to put them in the chat and we'll go through them as needed.
And feel free to also stop me as I'm going through here. So this is joint work that we did with the Franchise Tax Board, which is our state income tax authority in California, the Department of Social Services, and with Code for America. So a little bit about the Policy Lab before I get started. As I mentioned, we're a research institute. We work almost exclusively with person-level data within the state of California. Our sort of niche is working on very sensitive data. And our aim is to work together with government partners to try and generate new research that has a sort of real-life impact for people on the ground that really changes the way that government works. And you'll see that through this project. We work with data on income, taxes, unemployment insurance. We work with safety net data, health data, criminal justice data, education data, and we do research in a lot of different areas as well. And one of the areas that we sort of specialize in is being able to do this sort of cross-disciplinary, cross-silo research that I'm going to talk about today. So let's dive into the policy problem here, which is that a lot of benefits, much more than just a few years ago, are delivered through the tax system. the group of anti-poverty tax credits, which really used to just be the federal earned income tax credit, has expanded to other types of credits as well, especially during the pandemic. Now, a lot of those have rolled back, but I don't think that means that in the future there won't be more delivery through the tax system, which, if you step back to think about it, is really not set up primarily as a system for payouts. It's more set up as a system for receiving money. And so, as we've worked with the Franchise Tax Board in California, one of the comments we've gotten from them consistently is like, the EITC and other sort of payouts, obviously they do issue refunds, but they don't see themselves as a safety net provider. They see themselves as, a tax collector. And so they aren't always prepared for the types of issues that, like the Department of Social Services is prepared for. So these anti-poverty tax credits, turns out that they lift millions of folks out of poverty every year. The states like California and Oregon also have state versions of some of these things. So there's a state earned income tax credit in both California and Oregon. And in California, at least, I'm not sure about Oregon, there were state stimulus payments that happened during the pandemic. So anyways, there's all these anti-poverty tax credits that are delivered via the tax system. And it's a lot of money. So if you sort of look at the period of during the pandemic, and using an example family that has one child under the age of 5 and very low earnings, you can see that at least in California, this ends up being more than double the income that this family would have made in that given year. The problem is that, and I should just mention this box over on the right, which is that with taxes, you have 3 years to go back and file for prior years. And so these pandemic credits are still available to many families. And in particular for people who didn't file during those years, which is what I'm going to talk about right now. So the trick is that even though there's all this sort of money on the table, there are a lot of eligible families who don't actually receive it. And one of the main reasons is represented here, which is, and I'm using California information here. Oregon's state EITC works a little bit differently, but I think the point here is the same, which is there's a group of people who are not required to file taxes, and those are folks who are making about $12,000 or less. And in many cases, they don't file taxes because they're not required to. But those are the same folks who are eligible for these anti-poverty tax credits. And so even before the pandemic came around and all these new tax credits like the child tax credit and the pandemic earned income payments, or sorry, not earned income payments, economic impact payments came around, there were a lot of folks who were eligible but not filing for the earned income tax credit. Okay, so that leads us to 3 sort of tough policy questions or research questions, really. One is, how many folks qualify for but are not receiving these types of benefits, which comes down to who are the eligible non-filers. The second is, okay, once we know that list of folks, how can we close the gap? And then the third is, if they receive these credits, how many Californians are lifted out of poverty? So I'm going to start with the first question, which is just trying to understand, how big is this, call it the gap, right? How many folks are eligible but not filing? And that turns out to be a tough question to answer because no one entity within state government has all of the necessary data. So tax agencies know who files for taxes and who receives credits. They have individual information on non-filers because they get information returns, like, W-2s and 1099s, but they don't really know who is actually eligible among those folks. Now, on the other side, there's a lot of state and local human services agencies who have a bunch of information about families and their incomes and the number of dependents that they have. And so they know a lot about eligibility, but they don't really know which of those families have filed for and received the credit. So getting that take up, which is really the number of eligible non-filers over all of the eligible individuals, is something that requires data from both agencies. Okay, well, let's just find the data and smush it together, right? It actually turns out to be not that easy. So there's a privacy challenge here. To link data at the individual level, you need to have individual level, personal identifiers. In this case, social security numbers, but also names, addresses, things like that in other cases. And what often happens is that you have two agencies that want to achieve something that requires both data sets, but they don't want to share that PII. And that could be because there's a statute in place that prohibits the sharing of PII. It could be because they don't really trust the data security of the other entity. It could be because they just have some, worries about privacy that are not based on statute, but are still very relevant. But in any case, we run up against this challenge quite a bit, which is there's two agencies that actually are interested in doing a project together, but they don't want to share PII. They would be happy to receive it, but they don't want to share it. All right. So the solution that we've been using is a solution that's called privacy preserving record linkage. That's the long name. And I use that name just so you can go look up other research that uses that technique. And there's all sorts of, I'm going to describe one way of doing this, but record linkage. But I'll just describe the way that we did it. All right. So you basically find a third party, kind of like a Switzerland, a neutral party, who receives encrypted PII from both entities that's encrypted in the same fashion. And then the third party links together the encrypted versions of the PII. So imagine you took a social security number, you sort of put it through, a scrambler on both sides that's in the same scrambler. The third party doesn't know what that scrambler is, but both of those entities do it in the same fashion. Then the third party just receives a bunch of gobbledygook that it's able to link together, and then you're able to do projects using the linked data. So in our situation, the two entities were the tax board and the Department of Social Services, and the third party was the California Policy Lab. Okay. And again, the goal of this linkage was to identify enrollees of the SNAP program, in particular, food stamps, or used to be known as food stamps, that were eligible for but not claiming several benefits. We actually started this project when we were only looking at the EITC, but then when the pandemic hit, tax delivered benefits, tripled in size. And so we were then looking for stimulus payments and the child tax credit and other California specific things. So a little bit more about how that actually works. The encryption that I mentioned on the prior slide is actually a process called hashing. I'm going to go a little bit into the detail here. Michael mentioned there's some more technical folks, so maybe this is helpful, but hashing is a one-directional encryption process that transforms an input string into a unique hash value. Okay, so this is a couple examples down below where, an example social security number goes through the hashing algorithm, transforms into a unique hashing value. Even if there's just one letter or number that's different, even if it's like lowercase versus uppercase, the hashing value is completely different. Like there's no similarity between the hashing values just because the input string is quite similar. Okay, and that's a function of hashing, which you can look up a lot about hashing, but it's basically a cryptography method that's used very commonly in just about every sort of app that you use on your phone. They're hashing your username and password, for example, or at least your password, so that they're not storing your password in clear text, because if they get hacked, that becomes a problem for them. So they store that your password as a hash, and when you put in your password, they hash the thing that you put in to see if it compares to the thing that they have stored. So point being, hashing is a very common method in a lot of tech companies. And if you use a good enough hashing algorithm, it's really mathematically pretty impossible to reverse engineer that back to the input string. Okay. Now, hashing also has this thing. All of this sounds a little bit like breakfast to me, by the way, the sort of hash and salt and all this. But the process of hashing usually includes adding a salt. And when you add a salt, you can just think of that as a password. But you're basically adding a string, an agreed upon string to the hash, to the input string before you hash it. Okay, so an example is below, where instead of hashing the social security number, you're adding I love apple pie to the end. And then, of course, that creates a completely different hash value. And as long as both of the entities are using the same salt, then and they don't share that salt with the third party, then what you've created is this nice sort of situation where the third party has no way of creating new hash values that would match with the ones that are given to it by the contributing agencies. So we usually will get on the phone, we sort of explain how to pick a salt, then we get off the phone and the two agencies decide upon a salt together. Okay. So here's the sort of process flow, what it looks like in our particular use case. We took tax filing data from the FTB and safety net data from the Department of Social Services. Both of those were hashed and transferred to the policy lab. And then the policy lab merges the hash data. And in this case, what we did was we generated a list of folks who were on SNAP but did not file a return. And then we sent that list to the Department of Social Services. So the only thing the Department of Social Services got back was a list of their clients who hadn't filed for taxes, hadn't filed taxes in the prior year. And then what I'm going to get to in a bit is they then use that information to do some outreach to folks. But before I get to that, I'll just mention that there was a lot of behind the scenes work to make this, work. And I would argue that we could have done it without statutory changes, but there was some folks at the tax board that felt better about making this clear in statute before moving forward. So there was a law or actually a couple of laws that were passed to make this possible. You'd have to check with your own lawyers about whether that would be necessary in your state. Okay, so the first result was just looking at this EITC gap or this benefits gap. And what we found was that the tax system actually did a pretty good job for the most part, which is that about 3/4 of folks who were eligible did receive, for example, federal stimulus payments automatically or the child tax credit automatically. That's great. What we found, however, was that for the remaining 25%, they tended to be folks who were single and didn't have dependents, had no wage earnings, observable wage earnings whatsoever. And of the children who didn't receive these credits, and a lot of these credits were going to reduce, were going for the purpose of reducing child poverty. Most of those children lived without a single adult, and a number of them, about a quarter, were in situations where there was no adult on their case, which I know is sort of a strange way of putting this, but what that means is that they were likely undocumented, their parents were undocumented, and so they could be on a SNAP case, but their parents couldn't. So when you see these child-only SNAP cases, it usually means it's a mixed documentation, mixed status family. So that was helpful to be able to sort of know who's eligible for but not claiming the credit. That alone gave the Department of Social Services some information to be able to target folks. But when we gave them the list, that gave them a target list. And so we moved on to the second question: how do we close that take-up gap? And I just want to emphasize here, these tax credits are quite important to families who are making this amount of money. They can really change whether a family can sort of make ends meet. And we just saw recent research just a few weeks ago that showed that child poverty, went back up after the child tax credit was discontinued. And so this was really valuable work that we were really happy to be doing with Department of Social Services. So we conducted an outreach campaign with them and actually sort of staggered the implementation of it so that we could measure the impact that this outreach had. We conducted outreach via voicemails and via emails to roughly 400,000 non-filers in the state. And what we did was we directed them to go over to this app that Code for America has built called getctc.org, which, Code for America has been involved in creating this non-filer portal at the federal level as well. So that was great. Did it work? Yeah, we did find that it worked. Those receiving the email were 5 times more likely to file than those who didn't. And I should say everybody received the email eventually. It's just that we sort of delayed the emails so that we could see the impact of getting the email. Voicemail 2 times more likely to file. So that was helpful information to see the difference between those 2 mediums. And the campaign caused, again, because of the way that we did the research design, it's sort of hard to measure exactly. But my guess, about 2,000 more returns were filed as a result of the campaign. And I would say about $7 million in additional refunds. Again, I'm using something that's sort of in the middle of our 2 sort of lower and higher bound estimates. And a tremendous cost effectiveness, right? So every dollar spent on voicemails yielded $52 in additional refunds, and every dollar spent on emails yielded $10,000 in additional refunds. And keep in mind, these are extra federal dollars coming to the state. So this isn't actually state funds that are being, for the most part, spent out. There are some state funding, but it's mostly federal dollars that are coming. Now, there is some bad news, right? It's still 2,000 returns. We sent this to 400,000 folks. So this is still not getting everybody who's a non-filer. And one of the things that we're exploring with the Department of Social Services is more high-touch methods of trying to get non-filers to file taxes and claim some of these credits they're eligible for. So that's sort of for future study. I'm going to sort of stop. I'll go very quickly through the remaining slides. We created a hash linkage toolkit if you're interested in doing this in Oregon. This is the website, and it has a guide for departmental leadership as well as a step-by-step technical guide for the staff who would actually be implementing the hash linkage. And we have the code that we use for doing the hash linkage up on our GitHub as well. If you want to do this in Oregon, reach out to us once you've consulted these resources. We'd be happy to try and help. This is sort of a brief preview of some of the stuff that's in the guides. You have to sort of plot out your strategy in advance, and then there's these implementation steps. I won't go into depth here. And then we have a decision tree as well about what's the best pathway to linkage. I should mention that if you can avoid doing a hash linkage, that's actually better and easier. So there's some things to consider in terms of how you would achieve the same outcome in different ways. Again, I'll emphasize hash linkages take a lot of time. They take a lot of resources. They should probably only be used when there's no other viable pathways to linkage. But when they do, when they are necessary and when they do work, they can be incredibly powerful in being able to answer research questions and also change things on the ground for folks like we did in this particular case. So we're doing a bunch of other hash linkages in California. The Social Services Agency is our main partner on this, so you'll see them mentioned a lot. And the other partner that we work a lot with is one of the 3 nationwide credit bureaus who's provided us credit information for everybody who lives in California, as well as a 2% sample nationally. So we're doing a lot of these hash linkages. We think that they have a lot of benefit, and frankly, we learned a lot the first time around, and now it's getting a little bit easier to do these going forward. So I'll stop there and see if there are any questions. Hopefully I've left a few minutes for that. And thank you all for listening and for your time.
I've got one question here. Somebody asked if any of the social service clients pushed back on how, the Department of Social Services got that information on their filing status.
It's a reasonable question, but no, we haven't heard from anybody who feels that way. Yeah, I think on it. I mean, I think that's a very reasonable question. I think you could imagine that there are some folks out there who feel that way and haven't reached out. I would also mention, though, in our interactions with folks who we interacted with as part of the SNAP clients and people who are applying for the EITC, a lot of them were happy to hear that government would, they get very frustrated that they have to fill out the same information in 7 different places in order to get all the different benefits that they're eligible for, and they're frustrated that government can't figure that out. So I think that in this case, they see this as, I think the majority view is really like, this is how government ought to work. This is good government. Thank you for trying to, help me get benefits that I'm eligible for.
All right. Looks like we've got somebody that's just going to direct message you some. I had a question, which was, I know you said it can take quite a long time, and I imagine the majority of that is probably the, making any statutory changes if you need to, even if you don't, just like clearing it with lawyers and stuff. Once both agencies have, done the salted hashing of the PII and then sent it to, whatever third party, in this case, like, California Policy Lab, how long does it take you to kind of compile the data set that is needed and then forward that on to whoever's going to use it?
Yeah, good question. It very much depends. So I would say first, before I answer that question, the hashing process is actually has proven to be the more complicated portion, both because you're dealing with 2 different agencies who might have 2 different environments, like technological environments. And so we found that like special characters get treated differently. They might have different character encoding. They might they have to both hash the data in the same way, but they have to also clean it in the same way. So a lot of this comes down to which PII you're actually using. If it's just social security numbers, the process is much easier because socials can be stored in a very uniform fashion. They can be hashed. And then to answer your question, if it's just socials to be linked together, that process can take a few days. Can be very quick. If, however, you're dealing with names and addresses or names and birth dates and zip codes, which is some of our other hashes, that can be much more difficult because names are stored and addresses are stored in different ways on different systems. Addresses might be stored as address 1, address 2 on one system, or might be split out into 16 different fields on another system, like street number and prefix and suffix and street name and all that. So point being, like, social security number only linkages can be easy on the hashing end and easy on the linkage end. But if you have other PII, it's harder on the hashing end and it's harder on the linkage end. I will say, however, we've created linkage code that you can reuse for the purposes of what you were asking about. So you can sort of tweak the linkage code to whatever parameters you want to emphasize in the linkage. I didn't get into this, but you can, as long as you do the cleaning steps in a certain way, you can actually do fuzzy linkages. So imagine hashing just the first 4 letters of every name, or just the social security number. You could take 1 digit out and hash the remaining 8 digits, so that if there is one transposition, and do that 9 times, if there is a transposition, like somebody entered it wrong, you could see a social security number that's close but not exactly the same. And then you could look for other information like names or dates of birth to sort of confirm that it is the same individual. So that was sort of a long-winded answer to a simple question, but nothing about this the first time was quick.
Mm-hmm.
Yeah. And in answer to the question in the chat, yeah, we do have organizations in California that help folks file for taxes. Both, VITA organizations, United Way, Golden State Opportunity is one of them. And we've worked with them in other contexts and on other projects to get more folks onto the EITC and other tax delivered benefits. They just weren't involved in this particular project.
Great. Well, if I'm not seeing any other questions, so thank you again for presenting. Really appreciate it. And yeah, we'll switch over to our second presenter, Len Burman.
Great. Thanks, y'all, and feel free to reach out by email if you have questions.
Thank you. I'm pleased to be here. I'm glad I showed up in my office early because it took me 20 minutes to get my computer to start up. But I'm going to try to share my screen. And maybe, what's it doing? Okay. Okay, now I'm really confused. I clicked share.
I have your slides if you end up just wanting to do it that way.
I would really love to be able to pull mine up. It's actually, let me see what happens if I click that. Are you looking at my screen now?
I'm looking at your Outlook.
That's fine. I totally want you to see my Outlook. How about this?
There we go. There it is.
Okay. Just hit a milestone birthday, and every time things like this happen, I think I'm just too old for modern technology. But I'm talking about technological solutions to issues having to do with privacy. So this is totally appropriate. And you can figure out from my intro that they're younger, smarter people who are actually doing all the work. I'm just the pretty face. I'm talking about synthetic data and also a little bit about validation server, which I think is a really, from my perspective as a researcher, exciting technology. This is a photo I found of the original Moog synthesizer, which was it produced primitive synthetic music. It was not really all that objectively interesting. I spent many, many weeks at the Franklin Institute in Philadelphia playing with this thing, having it make sounds and presumably squealing with delight. But the thing that I think is relevant about this is if you think about where the original synthetic music was and where it is now, it's been this remarkable transformation. There's a lot of music, a lot of electronic music does things that wouldn't be possible with real instruments and that people really want to listen to, like everyone under the age of 30 who goes to dance. And I'm optimistic that even though synthetic data are probably closer to the Moog stage than they are to electronic dance music, that in 50 years and hopefully a lot less, they could just transform economic research. So this is, okay. I'm going to be talking about synthetic data validation server. We're working with the Statistics on Income division of the IRS to create high quality, fully synthetic public use file as a safe replacement for the traditional public use file, plus a validation server that will allow researchers to safely use confidential data. The research is supported by the Sloan Foundation, Arnold Ventures, National Science Foundation, and recently the Internal Revenue Service. Thank you, Inflation Reduction Act. What are synthetic data? Synthetic data are fake data. They're basically designed to replicate the statistical properties of the underlying distribution of data without including any identifiable information about any particular records. So if you think about, imagine a world in which tax data were perfectly normally distributed. So imagine a bell curve. You could just draw values from that bell curve. It would look just like the distribution of the underlying data, but it wouldn't include any actual information about the actual points that were in the underlying data set. There'd be no disclosure risk whatsoever. Obviously, text data are a lot more complicated than a normal distribution or a bell curve, but there are ways to create an empirical version of the multivariate distribution of tax return information and draw data points at random from that distribution. And that's basically what we're doing. There are two kinds of synthetic data. So there are some synthetic data sets that are called partially synthetic, meaning that some of the values are the actual values drawn from the underlying data because they're considered not to be a disclosure risk, and other values are synthesized. They're drawn from this statistical distribution. For the IRS, we're working on creating a fully synthetic tax data set. And that means that every value in the data set is drawn from this statistical distribution rather than from actual individual tax return records. So why synthetic data? Well, for one thing, protecting confidentiality has become more and more challenging, as I'm sure all of you are aware. And the literature on privacy has revealed that the threats are even greater than previously recognized. And the IRS has put a lot of effort into protecting the confidentiality of the underlying tax data. But the methods they've been using so far are somewhat limited, as I'll discuss in a moment. The data that the synthetic data, sorry, I'm looking at my notes and now I'm getting confused. The tax data themselves are useful not only to government entities, but they're also useful to researchers who want to look at how people respond to tax policies or to model the effects of changes in policy. And limiting access to those data limits the kind of analysis that can be done. There's a tension between protecting the confidentiality of the tax data and the public benefits of research, and that's what these technologies try to balance out. Synthetic data can only take us so far. For example, it's unlikely that a synthetic public use file would support nuanced econometric modeling. A lot of the modeling that economists do is looking at kink points, like when tax rates suddenly rise or fall. How do taxpayers respond to that? Gives an idea of how sensitive, how responsive economic behavior is to tax changes. Those kinks get kind of washed out in the process of creating a synthetic tax distribution. A validation server would actually allow statistical analysis to the underlying data and then add noise to the estimates before the results are released. So it's based on the actual data, but instead of seeing the actual parameter estimates that you would get if, say, if you had this set up in Oregon, if you ran a statistical analysis on the data inside the revenue service, you would see the actual estimates that came out of Stata or something else. Validation server, the estimates will be altered just a little bit, but basically enough to protect against disclosure of individual records. The process of adding noise still produces statistically valid estimates because the noise that's added is completely random, unlike other kinds of things that distort parameter estimates that create bias. This is random noise, and it just basically makes the estimates a little bit less precise. And there'd be a strong measurable privacy protection. And having synthetic data with a validation server could allow a much wider range of research access to data with more robust privacy guarantees and lighter demands on tax agency staff who currently, when they work with researchers outside of, say, the IRS, I'm sure this is true in Oregon as well, they have to check every single table that comes out, make sure that there's no disclosure risk. And that process is time consuming, and it's also not perfect. That it's possible that checker could miss some information if someone were really trying to infer information about the tax data. And I realized the slide had moved forward while I was talking about the last one. So the current status of the project is, first of all, we've created the first fully synthetic non-filer database. This is information that the IRS has about people who don't file income tax returns. They get it from information returns that come from financial institutions and other entities. They get some of the information from Social Security Administration. These data have never been released publicly, but they're really important because if you're trying to look at the whole distribution as opposed to just the subset that files income tax returns, you need information about the non-filers. So there's this synthetic file. We started with that because it's relatively simpler. It's a smaller database. The range on the data is somewhat limited. We limited the sample to people who did not obviously have an income tax filing obligation. So basically we cut out the people who might have been found later filing a late return or might have been illegally not reporting their income tax information. And the file is actually pretty good. It matches up with the underlying data pretty well when you look at aggregates. I'll show you some examples in a moment. We've created a synthetic public use file, which is the public use file is the IRS has for years and years produced a sample based on individual income tax returns, but with some privacy protections added on to it for outsiders to use for tax modeling and for research. We've created a synthetic version of that, so it doesn't have any actual income tax return information records in it, but is still designed to look as close, look as much like the actual underlying data as possible. We're working on a 2013 synthetic PUF. We're working with the IRS to produce their own version of a public use file for 2015. And if all goes well, the plan is to release a 2016 file as the first fully synthetic public use file, and that would be a replacement for the underlying, for the traditional PUF. And we're also developing the validation server. Tax data are a potential gold mine for research. The thing that I basically wanted to do a version of this project for 40 years since I worked for the Treasury Department and had access to data that I lost as soon as I left Treasury. There are so many things you could do, not only to measure how taxes affect behavior, but you can also use it for other purposes. For example, Raj Chetty, through an agreement with the IRS, has actually looked at tax data to measure the effects of good kindergarten teachers on people's employment prospects 20 years later. He's looked at economic inequality and how that's changed over time. But there are only a few people who can get access to the data directly through the IRS. And arguably some of the stuff that Raj has done even kind of push the boundaries of what the legal statutes would allow, because technically you're only supposed to look at tax data to the extent that you can improve tax administration or for some other very specific purposes. So the IRS has a small program where they let outside researchers work with people inside IRS to use the data through Joint Statistical Research Program, but that's a handful of people every 2 or 3 years who are allowed access that way. As I mentioned, the data are useful not just for public finance, but also in other fields. But there are significant legal constraints, and the IRS and other government agencies have limited ability to handhold people who are trying to get access to confidential data. The public use file is useful for tax model simulations. That's what the Tax Policy Center does. It's the agency I work with at the Urban Institute. We look at how tax policy changes affect the distribution of tax burdens, affect revenues, affect economic incentives. The So we need some kind of replacement for the PUF to do that kind of analysis, and I'm confident that the synthetic public use file will be useful for that purpose. Also, because the synthetic data set has a systematic way to deal with disclosure risk, you could actually include information that the IRS felt like they've had to suppress over the past 10 or 15 years. For example, they don't include state of residence on the file anymore. They used to. They could include more detail on business income, alternative minimum tax. They could use some of the demographic information they get from other agencies and make that available, such as age, for example, which they get from Social Security Administration. And the IRS could also, when we get to the point where this process is somewhat streamlined, not super resource intensive, they can produce other public use files. The IRS has tons of data sets that they create for particular projects, either with outside researchers or with the people inside statistics on income division. And something that I suggested and that the IRS is very interested in is creating a public use file as a companion to every one of the special studies or the major special studies that they do inside IRS. And that would mean that outside researchers would be able to work with the synthetic data, and then in tandem with the validation server, they could actually do their own statistical analysis on those data sets. I already talked a little bit about the threats of the threats facing tax data, which are extremely sensitive, and the government has a legal and a moral obligation to protect it. In the privacy literature, they identify three kinds of risks. We're primarily interested in the first two of those, identity disclosure, which is basically matching up data in a public data set with similar data they can find elsewhere. And there are, at this point, probably tens of thousands of data sets that exist in other places. And they might include some information that is included on the public use file, for example, that you could use to infer that this is actually the tax return of Joe Smith, who lives in Portland. Attribute disclosure, something like the fact of filing. You could figure out that somebody filed a tax return. Legally, that's an impermissible disclosure of tax information. Inferential disclosure is something the privacy people worry about. I don't so much. It's that if you contributed your data to a data set, the researchers could figure out from that data set that you're more likely to have particular attributes. For example, if you contribute to a health data set, and from that data set they discover that smoking increases the risk of cancer, that could increase your health insurance premiums. I think this kind of disclosure isn't recognized in the privacy statutes, and I think the whole purpose of research is to find out, generally how people, businesses respond to different incentives. So the fact that you might discover that somebody like you would be more likely to have capital gains is I don't think a huge risk. And certainly if inferential disclosure were not allowed, a lot of kinds of data access wouldn't be permissible. So I've gotten ahead of myself here. The IRS takes a lot of steps to protect the PUF. They create aggregate records for high-income people who'd be easy to disclose, basically just adding them all together rather than reporting any individual tax returns. They swap data between similar records. They do other things. These protections they distort the data in ways that are hard to unravel in statistical analysis. The protections they create may not be robust to future threats. And the approach that we're working on I think, provides a much more robust and a much more robust way to protect these data while providing more access than exists currently. So I'm actually going to, just in the interest of time, I'm going to go fairly quickly over synthetic data processes. I've talked about it some already. I'll show you the next slide because I like it. This is my proof that good synthetic data exist, and this shows that I'm not really very up on theology, but it's called the random rapture theorem. And the idea is that suppose a randomly selected 1 in 1,000 people just are raptured, and unlike in the biblical rapture, first of all, they're selected at random rather than based on their characteristics. Second of all, when they disappear, all of their history on Earth also disappears. So they basically never existed, but their income tax returns remain behind. The random rapture sample is an ideal synthetic data set. By definition, it doesn't represent any individuals, but it's just a random sample of tax returns. Presumably, that would look like any other, have the same statistical properties as any other random sample. So in principle, it says that a good synthetic data set exists. The problem is how to find it. And the work that we've done so far suggests that we can produce synthetic data, but it's not going to look anywhere near as good as the random rapture data set. The way we produce it in a nutshell is, so we're trying to create a multivariate distribution, which is the relationship between all of the different data, all of the different variables in our data set. So first we just draw some base variables, say wages and salaries, from a smoothed version of the distribution of wages and salaries that we get from the tax data. Second, we might look at a second variable like interest income, and we want to look at how that's related to wages and salaries. We could do an econometric model and just say, as a function of wages and salaries, this is the equation we could use to predict it. But the relationship isn't anywhere near, wouldn't look anything like a linear regression or even one with, lots of higher order terms in it. So like I think virtually everyone else who creates synthetic data, we use a non-parametric method called classification and regression trees, or CART. And basically what it does is it groups together underlying records based on their similarity and then draws so each one of those has, say, a value of interest. So it draws a value for interest income from all of the interest income values for that group. We also do some smoothing, so we're not actually taking actual interest income values, but something that might be somewhat close to them. And that's how we predict the second value, and then we predict the third one based on wages and salaries and interest income. Maybe the third one will be dividends, and so on. So the goals for the synthetic data is that we'd like it to be close to the distribution of the underlying data. So that's general utility, also specific utility. We'd like it to be useful for particular purposes. For example, one focus of our work, which is maybe not surprising given the Tax Policy Center's focus on microsimulation modeling, is that we'd like to be able to model the effects of changes in tax law and for the synthetic data to produce reasonably reliable estimates of that. So how good are the data? By some metrics, the quality is very high. The correlations, the SynPuF is just we're calling the synthetic public use file. The correlations between values closely match the underlying data. The weighted means for most variables closely match the underlying data. The overall distribution of adjusted gross income, which is a key variable, is close. By other measures, they're not as good as we'd like them to be. The standard deviations for some variables don't match up. There's too much income at the top 1% of adjusted gross income. There's some particular variables that we can't measure very well. A few of them are because they're just the sample sizes are relatively small of people who have non-zero values for those. In that case, it makes sense for them to be distorted a fair amount. But for others, we think we can do better. And we have a long list of things we're trying to do to improve the quality of our estimates. Here are some charts. There's means in the synthetic public use file and the public use file for the 2012 test. And you can see that actually the public use file, or the synthetic public use file, is actually closer to the 45-degree line, where the means are identical for the two. We actually think we have ways that we can make the means match up exactly, and they will in later versions. The standard deviations are also, reasonably close. In the synthetic puff, you can see that there are some bigger misses in the traditional public use file. The correlations, the correlation between variables are also pretty close. This is just sorting all the variables from biggest difference in biggest undershoot on the correlation to biggest overshoot. And you can see that, 90 to 95% of the correlations are very close to zero, or the differences are very close to zero, meaning that the pairwise correlations are represented pretty well. This is showing, this is just a, this is kind of a garbage regression where we regress salaries and wages against age, filing status, number of children, eligible for child tax credit, and primary taxpayer exemption. And to see the regression coefficients on each of those variables. And you can see that in this particular case, there are no statistically significant differences between the synthetic data and the original data. This actually doesn't show the means and standard deviation of the coefficients for the traditional puff, so that's not too bad. In some cases, the synthetic data are better than in the puff, maybe not too surprising. These are some examples. In some cases, they're worse. So qualified dividends is a share of total dividends. This is something we're going to fix, but in the initial CART algorithm, qualified dividends are like the things we normally think of dividends, whereas non-qualified dividends are things like interest paid by mutual funds, which are treated as dividends in the code, but they're taxed as regular interest. In that case, there are big differences in the synthetic data. So part of this is just the process of we need to we need to impose constraints on the relationships between variables. I realize I'm running out of time, so I'm going to talk even faster. But so I've actually talked about why validation server. It's a more systematic way to protect against disclosure. The amount of noise added to estimates depends on how sensitive those estimates are to outliers. And for a lot of kinds of analysis, like for example, if you're looking at the earned income tax credit, the amount of noise will be quite small. It could be, in principle, fully automated. People don't need to get into the IRS to get access to the data directly. They never would see the underlying data. And the privacy protection would be much more consistent than it would be with manual review of statistical estimates, which is the way the IRS does it now. Validation server basically accepts a submitted research program, something you could put together in Stata, for example. You could test the program on the synthetic data. Synthetic data would have the same record layout as the underlying data. You'd have a high degree of confidence that would run on the validation server, and then you get the estimates through the validation server. There are going to be some education requirements for people who use this because it's going to be a somewhat different way to do research. First of all, you can't run thousands of regressions looking for results. From my perspective, trained in econometrics, I think that's a good thing because it means there'll be a lot less data mining. The estimates will be more statistically valid. There's going to be a thing called a privacy budget, basically a thing that limits the total amount of information I can draw from the data. And people would need to understand that. But the key thing is synthetic data are an essential complement to the validation server. The challenge is, the main one is just getting reasonable process. We basically have a methodology. It's similar to one developed by Chetty and Friedman, but they did it for a relatively small data set with data that is easy to analyze in this context. We're looking at a large data set that's hard to analyze, and we're trying to come up with algorithms that would allow us to get estimates quickly enough people wouldn't lose interest. And this is, if this sounds a little bit complicated, it's a little bit complicated. The thing that I think is exciting is the Advisory Committee on Data for Evidence Building, which I served on, specifically recommended that there be help to state and local governments so they could adopt these technologies, block grants to states to hire people with expertise in data science, and technical support for data stewards, and training and guidance for data users. So with that, I'll wrap it up. If you have any further questions, obviously I'll stay here for as long as you like, and feel free to send me an email or call me. And I guess I should unshare my screen. Stop sharing.
Great. Well, thank you very much. Let's see. Of course, anybody has any questions, feel free to drop them in the chat. I had a question. So you had mentioned a few different variables in the in your presentation. So I was wondering, like, there are the relatively obvious ones: age, income, interest, dividends, that kind of thing. Are there other, like, more niche variables that you are modeling, or what, basically, without trying to like have you give the full rundown of every single variable that you're modeling, can you give at least an idea of, like, kind of the complement of maybe how many variables you guys are trying to model as part of the data set?
I could read the whole list and you could all record it and use it if you have trouble sleeping at night. There are about 200 variables in the public use file, and they include a lot of detail from all of the forms and schedules that people file, so it's got everything, basically everything from the 1040 form: interest and wages and salaries, self-employment income, interest and dividends, capital gains, alimony, things like that, all the deductions that people report on Schedule A, mortgage interest, state and local taxes, charitable contributions. For businesses, their gross income and a little bit of information on their deductions. There's not as much business information as researchers would like because of privacy concerns. One of the advantages of the PUF is that we can include more of that. It includes detail about capital gains. Again, there could be more detail on the synthetic PUF because capital gains have some huge outliers. You need to protect those, but you can do that in a systematic way with this process. You think about all the information that's reported to the IRS, the potential is huge. The INSO file, which is the one that the government agencies use, Treasury, Joint Committee on Taxation, that includes something like 1,000 variables. It's got information about health insurance from the forms that employers file about the insurance they provide for their employees, and information that they get from the health insurance exchanges. They have information about retirement accounts, comes in from information returns. There's actually a ton of information about retirement, most of which has never been made public as microdata. So I think it does remind me of the old Woody Allen joke. Woody Allen says an old couple comes home from a restaurant to their retirement home, and somebody says, "Well, how did you like the restaurant?" And the wife says, "Oh, the food was terrible. You couldn't even eat it." And the husband says, "Yeah, and the servings were so small." And so, okay, so maybe the synthetic data won't be perfect, but we'll be able to give you a lot more of it. But it is useful. It'll be useful because you at least see something about the distribution of these variables we hadn't learned about in the past, and you can use it as the basis for doing a econometric analysis through the validation server mechanism.
Very interesting. Well, I don't see any other questions, and we are quite a bit over time, so
Yeah.
I think we'll let people go. But thank you again for presenting. This was great.
Thanks for inviting me. This was fun.
Yeah.
And I also was really interested in the part of the first presentation I heard, which I guess I'd heard a version of that earlier as well, but that's really exciting stuff. And that's then, you think about the whole toolkit of, safe ways of linking data. That's the other component. So ways of doing econometric analysis on particular administrative data sets, and then ways of, for example, linking census data, which has, a huge amount of demographic information, with the tax data, which has really good information on income and some deductions. That would be a game changer.
Mm-hmm.
Thank you for inviting me. This was great.
All righty. Yeah, thank you. And thanks everybody else for coming. Have a good rest.